This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set to extend Wall Street's rally after US factory inflation numbers back the case for a Fed cut. New Zealand's Reserve Bank makes its policy call shortly. Earnings in focus too. Profit Australia's biggest bank meeting forecast despite a weaker economy. Tencent set to report later with analysts expecting a robust quarter. Plus, Bloomberg reveals that the US Justice Department is considering a rare bid to break up Google after a landmark antitrust ruling. We do have more data just crossing Bloomberg, really adding to kind of the narrative as to where global central banks head from here. We do have jobs numbers out from South Korea at the moment. Of course, one of the sort of points of weakness for the South Korean economy has been particular parts of the labour market, particularly when it comes to youth unemployment. We are getting the July adjusted jobless rate falling to 2.5%. From the estimate of 2.9% is what we're seeing. So quite a significant divergence from the difference that we're seeing. Does this sort of make a difference when it comes to the Bank of Korea? That's sort of still yet to be seen, given that we have seen quite a bit of resilience in other parts of the economy, including the likes of trade, for example. But the July jobless data coming through with that jobless rate in particular falling to 2.5%. The estimate was for 2.9%. So that unemployment data perhaps a little bit surprising for these markets, Shery.
Yeah, not to mention surprising the consumer inflation, also not to mention housing inflation in South Korea has been pretty strong, so sort of pushing out that BOK potential rate cut perhaps until October. Of course, inflation has been such a key factor the central bankers around the world have been looking at, right? And we got overnight U.S. PPI numbers also rising less than expected for the month of July. And of course, the key components there to watch were those that filter through the Fed's preferred gauge of inflation, the PCE index, and those also looking pretty tame. So we'll be looking forward to the CPI numbers, of course, and the expectation for the Wednesday figure is for both core and headline inflation year on year to come in at the slowest pace since early 2021.
Yeah, that is really front and centre in terms of how we're going to be interpreting further guidance from the Fed. Right. In the meantime, we're also very closely scrutinising any sort of Fed speak and commentary from Fed members. Raphael Bostic reiterating, I should say, that more data is needed, that a rate cut, though, is likely by the end of the year. He's likely, I should say, to support the idea of a rate cut before we get to the end of the year. This is, of course, the Fed Reserve Bank of Atlanta President Raphael Bostic saying he's looking for a little more data before supporting a reduction in interest rates. He says he wants to be sure that the Fed will not have to change course once it begins cutting. We want to be absolutely sure. And Shery, this is sort of the issue of maintaining credibility, right? They certainly don't want to have to start and then stop and potentially change tact again.
And yet markets are really pricing in more than 100 basis points of rate cuts already this year, right? And we saw Treasury yields plunging in the overnight session, stocks also gaining ground. And what was really interesting about the overnight session as well was when we got those CPI numbers coming in slower than expected. Last month, for example, we saw that great rotation away from tech and into cyclicals. Not this time around, though, because we saw the Nasdaq 100, for example, outperforming the Russell 2000 in the overnight session. We're headed towards a CPI numbers, and more than half of those recently surveyed now saying that we might see a risk-on reaction in the markets. Take a look right now at U.S. futures, not doing much, but let's see how the open in Asia is setting up, because we also saw the dollar really falling in the overnight session. That pushed the Japanese yen slightly higher, but we've been really consolidating around that 146, 147 level for the Japanese yen. And we have seen, of course, that incredible rebound and comeback for the Japanese stock markets. The Nikkei now at levels back before last week's Black Monday. And that also sending the MSCI Asia Pacific index also higher. Of course, Japanese stocks have the biggest weighting there. Right now, this is the setup. Really not doing much, although Sydney futures are higher by 0.7%. What we'll be watching, Haidi, today as well is the RBNZ, because right now the consensus is for it to hold rates steady.
And Shery, we were just talking about some of Raphael Bostic's comments, and still this kind of degree of caution to make sure they do it right? But our next guest actually says that the Fed is behind the curve when it comes to rate cuts, consistently slow to react. Terri Spath is the founder and CIO at Zuma Wealth. And Terri, I suppose you're sort of looking to see if this week's inflation number, we had the factory gate numbers, we're sort of still waiting on the consumer side, whether that feeds into the narrative. Do you think matters, in your view, for the markets and the trajectory forwards for investors, if that is the case, if the Fed is actually being too slow to react?
Well, yeah, I mean, there's a lot to unpack in that question. Thanks for asking it. Yeah, we do think, and we've been saying this for a while, that the Fed has been behind the curve. They're consistently slow to react. There's just no urgency. We saw that on the way of increasing rates and now also on decreasing rates. You know, what was nice today was that inflation report was generally cooler than expected. That's fueling hopes that the Fed will cut and as you pointed out, cut several times. But it's really time for them to adjust their policy and get moving. The risk that the risk about waiting to cut is that people aren't sitting in their living room and thinking, oh, gosh, rates just got cut 25 basis points. Maybe I'll go buy my house now. Or on the corporate side, cost of capital is still, high. And if it's down 25 basis points, that doesn't change a whole lot. It's really, it's not going to move the needle too quickly. And so we really think that the Fed needs to get going on things and just keep the economy safe here in the U.S.
And I know you're sort of not entirely into the US stock exceptionalism story, and we'll get to some of the other sort of more Asia-centric calls quickly, but what opportunities do you see after the recent sell-off in the US? Is there a question mark for you over the big run-up in the Mag 7 and AI tech-related stocks?
Yeah, I mean, we're constructive on U.S. stocks. We have been for a while. To be sure, the U.S. economy is slowing down, but it's not remotely close to recession. Unemployment's rising, but that's from historically low levels. The Federal Reserve, as we just talked about, is puttering, and they're leaving it late to cut interest rates, no doubt. But what we've been emphasizing, and we talked about it on your show before, and we'd like to say it again, is that Japan is, very underheld in the U.S. And the decision recently by the Bank of Japan to hike at the same time that we saw some weak economic data, gave some volatility in Japan as well as in many global markets. But the structural changes that are underway in Japan, the slashing of regulations, corporate tax cuts, much more, it's still very underestimated in our view. And any hesitation in the level for the Japanese stock market is presenting opportunities for investors. Earnings are still robust, dividends can still go up, they can still buy back shares. And so we really recommend and emphasize that investors take advantage of that volatility. Most investors, as we said, are underweight in Japan, and they should target a higher position than they probably have right now.
Obviously, I want to get to Japanese stocks, but before I get there, something that you said earlier that the Fed has been behind the curve, but then in your notes, you also mentioned that there's really far too little attention on the risks around the Middle East and from what's happening in Gaza. And of course, we also have the Ukraine war ongoing. Aren't these risks to the upside when it comes to inflationary pressures, especially with oil breaking 80 this week? Not to mention that, of course, we have political risk with the U.S. elections coming up, which perhaps means more fiscal measures.
Yeah, I think you're highlighting some really important points and bringing it even a little bit further than we've been talking about, which is that, the fact that there's been very little attention paid to these risks in the war in Gaza. It can absolutely escalate into a full-scale conflict between Israel and Iran. And what will happen if that does take place is a lot of bad things. But as you pointed out, energy prices will go up, and they'll go up a lot, and that's inflationary. It's also, an opportunity for energy stocks, and we don't see that reflected in the commodity markets. We're not seeing that at all. And so, it's a dog that hasn't barked yet for now, but an oil shock is something that we don't think is really being talked about a lot. Some of the things that you pointed out, that's inflationary. It's also, means something for commodity markets. And we would suggest that if there's a risk to our view right now in the outlook, it's that escalation is not being paid attention to. And if it does actually happen, it's going to really slap hard.
When it comes to the Japanese markets, are you factoring in that perhaps we will see sustainable inflationary pressures in Japan and a virtuous economic cycle, or are you talking mostly because of these value stocks, because it's really been undervalued for so long? Because after the incredible rally that we've seen this past year, I do wonder where can you find some of those bargains?
Right. Yeah. And I do think that there's it's more the latter when it comes to Japan, that it's an inexpensive, it's still inexpensive on a relative basis. And those structural changes that that we've been talking about a little bit are still very much underestimated. And so, you know, at 5, even with the rally, you know, and the rebound that we've seen more recently in Japan, we're still, you know, 5-6% below where we were a couple of weeks ago, and we liked it a couple of weeks ago, so we like it now. And again, we would emphasize that that's one of our top ideas is overweight Japan, at least get a market weight if you're not there already. It's one of our top ideas, that, the U.S., and, you know, still stay away from China. Those are our 3 messages right now.
Terri, Spath, founder and CIO at Zuma Wealth there. Well, we are on central bank watch, of course, and most economists expect New Zealand's Reserve Bank to hold its key rate when it makes its call in a few hours. However, a significant minority are predicting a 25 basis point cut after weaker than expected second quarter inflation and a slide in activity indicators for more. Let's bring in New Zealand Bureau Chief Matthew Brocker. So, Matthew, for this decision in particular, where do we see the split in views?
Yeah, well, it is pretty split, and of course investors see about a 2/3 chance of a rate cut today. Why the uncertainty? I mean, it's basically that, you know, on the one hand we have economic data really pointing to the economy contracting again, and what could be the 3rd recession in less than 2 years. Unemployment is rising, inflation is slowing, and as you say, several leading economists have called for the RBNZ to start cutting rates now. At the same time, we know the bank is worried about the stickiness of some domestic prices, so things like insurance, rents, local government levies that are still increasing quite rapidly. And perhaps most importantly, pivoting to rate cuts today would be a very big change of tune for the RBNZ. It was just 3 months ago that the Monetary Policy Committee said it considered raising rates and wouldn't cut them until the second half of next year. So for some economists, such a rapid about-face is just too much to expect from the RBNZ.
So how much of a real shift can we expect from the RBNZ's May projections when it comes to the economic outlook?
Well, I think most economists do agree that if they don't cut rates today, they will open the door to rate cuts at the final 2 meetings of this year in October and November. They would do that by changing their forecasts for the OCR. They could do that by saying that they did consider cutting interest rates today. Of course, if they do that, the question will then be, well, if you're flagging rate cuts, you're saying you're going to cut rates, what's the point in waiting?
New Zealand Bureau Chief Matthew Brockett there with what to expect from the RBNZ. Of course, that's a big rate decision today in the Asian session. And coming up on the Asia trade, Barclays joins us for a preview of Tencent's earnings, with analysts expecting a robust quarter. The CEO of South Korean fintech company Securities also discusses their strategy and expansion plans. Plus, we'll talk markets with SGMC Capital as traders boost bets on a September Fed rate cut. This is Bloomberg. Take a look at after-hours trading for Alphabet. Of course, we have heard that the DOJ is considering a bid to break up Google, and sources telling Bloomberg that a rare breakup bid is one of the options being considered by the Justice Department. If this were to happen, it would really be a historic move, especially after those unsuccessful efforts to break up Microsoft just 2 decades ago. Bloomberg Seattle Bureau Chief Anna Edgerton joins us now for more on this. Anna, so if the Justice Department does in fact seek a structural remedy here, which units are likely to be divested?
Yeah, the ones that we're looking at that would really address the harm that was outlined in this complaint is the Android operating system for mobile devices, the Chrome web browser, and possibly AdWords. Now, this is the platform that Google uses to sell text ads. So, we're really looking at how the Justice Department is going to suggest the judge imposes a penalty on Google in order to address the underlying harm that was found in this liability trial.
What else could be in the remedy, do we think, that the Justice Department is seeking?
Yeah, one thing that's widely anticipated to be in there is a prohibition on the kind of agreements that Google used to really solidify its place on mobile devices. Now, Google has paid billions of dollars to mobile device makers in order to put its Chrome web browser as the default on mobile devices. So we do expect whatever remedy the Justice Department seeks to really address that behavior, especially by banning this kind of agreement.
So when can we expect this remedy trial?
It depends. Now, we do anticipate that Google is going to appeal this underlying liability decision, and that could either happen before or after we get to the remedy discussion. So if the judge allows Google to appeal before we get to the remedy trial, that could put this off for a year, maybe 2 years. But if they decide to go ahead with the remedy discussion before they allow Google to appeal, then we could be seeing a proposal from the Justice Department in the next few weeks to months.
Anna, does this potentially have implications for other companies if it sets a precedent?
Yeah, I mean, it's been a question for the last few years as to how well our existing antitrust laws can really address concentration that we see in the technology industry. So this is a case that's going to be very closely watched to see how the U.S. antitrust enforcers use existing antitrust laws that are in some cases more than a century old in order to address a very new industry and a very new kind of business. So that's really what's going to be kind of at stake here, and what other companies certainly in the tech industry will be watching as well.
Bloomberg Seattle Bureau Chief Anna Edgerton there. Well, Chinese tech giant Tencent due to release their earnings later on Wednesday. It will be one of the most closely watched company reports across the week here in Asia. And Annabelle Jewellers has a preview for the second quarter numbers. So obviously for a number of reasons, not least of which it being a consumer bellwether, Tencent is really a standout.
And just speaking to that sort of consumer, there is the games division, of course, which has really seen quite a significant pickup, and we can get more on that in just a moment. But Tencent really stands out for other factors, given it's got perhaps higher barriers to entry than its peers in the space, because there's been so much challenge towards the e-commerce companies with the likes of Shein, Temu, for instance. Tencent, though, a little bit more insulated from that, and so not really seeing that same sort of price competition, a bit better risk profile as well. But the expectations for today, actually we should see a pretty healthy rise in net incomes, up around 50%. Revenue, that should have climbed as well, so around the 8% mark. And that should give Tencent better bandwidth to continue expanding its buyback program, which is something we're discussing across this week. It's sort of something that we should expect from a lot of Chinese tech giants. But Tencent, particularly with its cash pile looking quite healthy, it is in a good position to continue with this.
And also a lot of optimism over their gaming division.
Yeah, it's been such a significant turnaround story, really, because just 12 months ago, it was quite a different picture. But China has been quite clear. It's approving more games titles. It's trying to bring further regulatory stability back to the sector as well. And so this story's really been very much flipped on its head. In this current period, that title, you can see there, Dungeon and Fighter Mobile, it was released. Since it was released, it's been topping the charts for downloads and how much receipts or revenue is being generated from the game as well. So that's really a standout for this. That scenario is expected to sort of stay intact for the current quarter as well. So games is going to be continuing to drive growth. Our Bloomberg intelligence team, though, is saying don't expect this sort of scenario to stay in place going into next year. They're saying it should start to stabilise, but if 25 to 35% earnings growth is looking normal for 2024, 2025 should be around that 10 to 12% range.
And Belle, there's another big earnings report today. Hon Hai numbers are due.
That's right. So Hon Hai, we've of course got an indication because Taiwanese companies report their monthly sales figures. So what we're expecting here is that it should do fairly well, around a 25% jump in profit on an adjusted net income basis. Sales, they've risen over the period and what we've already seen from the company as well. The sales mix, that's something that's going to be really key to track because Hon Hai we know is Foxconn outside of Taiwan, and it is the biggest assembler of Apple's iPhones. Those sort of shipments should have probably stabilized in this period. What has picked up, though, is cloud products. That could have been a key generator of revenue. Cloud products, this is all about a demand for AI servers globally, but just generally Hon Hai is gaining market share in the cloud service segment, Heidi.
Our tech reporter Annabelle Jewell is there with a couple of the big Asian tech earnings that we're watching today. We do have some breaking news crossing the Bloomberg when it comes to the response now from the ASX. Of course, this is with regard to the Australian regulator suing at the ASX over what they say are misleading statements. So ASIC's chair, I should say, saying that the CHESS system project has not been progressing well ever since 2022, and Australia's securities regulator now suing ASX for what they call misleading statements related to this years-long process to upgrade the clearing and settlements system. So we're now getting that acknowledgement from the ASX, of course, which comes online in just about half an hour or so. Essentially, it's an acknowledgement of this lawsuit, saying that they've cooperated fully with the probe. They're carefully reviewing, considering allegations, saying that ASIC on its side is seeking declarations as well as pecuniary penalties and adverse publicity orders and costs versus the ASX. Helen Lofthouse, the MD and CEO, saying that they recognise the serious nature of these proceedings. So we'll continue to bring you more on this as the details come to us. Joe Longo, the ASIC chair, saying that the true state of affairs in 2022 was that the project was not progressing well, and that's contrary to what the ASX had said at the time. More ahead on the Asia trade. This is Bloomberg.
Growth is slowing, okay? Earnings expectations probably are still too high for the second half of this year. And a Fed that's reluctant to be proactive, okay? And I don't disagree. People are criticizing the Fed. I'm like, well, look, they're just being data dependent. I mean, and so they're doing their job. They're going to react if they need to. If they overreact, then that probably exacerbates the carry trade problem.
Morgan Stanley Chief U.S. Equity strategist Michael Wilson on the Fed's policy path. And let's get some more morning calls ahead of the Asia trading day. Citigroup strategists are seeing a significant sell-off risk for U.S. tech stocks. They say investor positioning remains extended on the bullish side despite the past month's sell-off, and any negative economic data could amplify declines. Tech stocks have been at the forefront of a global rout as traders worry about high valuations as the U.S. economy slows down. Share transactions in China have shrunk to their lowest level in over 4 years. Combined turnover on the Shanghai and Shenzhen bourses fell to around $70 billion on Monday, marking the thinnest trade since May 2020. Ying An Asset Management says it signals that the market is rife with pessimism. We'll have more on the Asia trade. This is Bloomberg.
This is the Asia trade, about 30 minutes away from the major market opens, and these are the top stories that you should know. Asia stocks are set to follow a Wall Street rally after US producer prices rose less than expected. The data reinforcing speculation that the Federal Reserve will be able to deploy an interest rate cut in September. Alphabet shares slipping after the bell after sources told Bloomberg that the US Justice Department is considering a rare bid to break up Google. A landmark court ruling earlier this month found the company monopolised the online search market. Bloomberg Intelligence expects Tencent to report strong second quarter results later, partly driven by momentum in its domestic video games business. Its new release, Dungeon and Fighter Mobile, has topped download and spending charts in China. Shery.
And Heidi will also get earnings from Alibaba and JD.com later this week, which could provide a snapshot of China's economy and broader consumer sentiment as well. Of course, we've had another somber earnings season expected in the region. With us now is Jiong, Shao, China Internet and Tech Analyst at Barclays. Jiong, great to have you with us. Should we get started with Tencent? So many names to go through, but it seems that at least their gaming business could see a turnaround. How about when it comes to the broader, weaker economic backdrop in China? Could we see that reflected in the results?
I think we're going to start to. I think this earnings season is very interesting. And you're going to see divergence in terms of the company's performance. Strong companies such as Tencent and such as Alibaba, which is improving, getting stronger, are going to have a pretty solid results. But some of the not as strong mega-cap companies may not fare so well. I think we have seen that the macro in China from consumption, from job market, has weakened notably in the last 2-3 months. And if this macro doesn't get any better, I think in the next quarter or two, maybe all companies will suffer. But right now, the stronger ones are doing much better than the relatively weaker ones.
Yeah. Despite the weakness that we're expecting going forward, at least until now, there's been a lot of expectation about share buybacks and dividends and more just shareholder returns, right? So what are we going to see in these results, and could we see that being pulled back as we see this reflection of the broader economy later on?
So the whole group is pretty cheap in a global kind of a investment theme. You mentioned about Google and some of the U.S. tech stocks early on. The multiples for some of the mid-cap U.S. tech stocks are multiples of the same multiples for the Chinese internet companies, right? But the reason behind that is because of weaker macro. Now, to counter that downtrend, a lot of these Chinese internet companies are doing, like I said, buybacks and dividend. For example, in Q1 and Q2 probably, Tencent is buying back $2 billion on average a quarter, and Alibaba is buying back about $5 billion a quarter. So as long as the fundamentals hang in here, now there's a big question mark. I think the buyback eventually will drive up the share prices. But it feels like a lot of investors, at least in the States, feel the Chinese government, some of the stimulus, some of the policy changes they are making, not decisive enough. It's all trickling down a bit here, a bit there. And the concern is that it's going to be too late before they become decisive.
I mean, this is less to do with Tencent, but I guess more about the question mark over the broader Chinese consumer and household sentiment, right? Is there a concern that if this is just a structurally slower environment, that business models like Tencent's sort of can only have one trajectory, which is pretty limited growth upside?
I think overall, the growth for the Chinese industries, including internet, is going to slow. That's almost certain. But there's a lot of debate about what are the structural reasons why that's the case. A higher level concern is actually on the policy front. Is that structurally, maybe there's not too much wrong with these Chinese enterprises and Chinese economies, but some of the policies, for example, in the real estate market, right? As long as real estate market, the property market is struggling, nothing is going to work. And China still has this somewhat very stringent home purchase restrictions in big cities like Shanghai and Beijing. So if that continues, I just feel like investors are going to lose their patience. That's why you see this kind of head fakes at least 3 times in the last 12 to 18 months. The stock bounce back and then economy weakens, stock go down again. Now the Tencent stock, which is primarily listed in Hong Kong, is doing a lot better than the U.S. ADRs for a variety of reasons. But perhaps Tencent management is one of the strongest management team in the industry, and the company is the most reliable executor in terms of its business plans.
For Tencent, how much of this is about gaming? And I know the expectation is that second quarter numbers is not really going to maybe truly reflect that revenue boost. But also more broadly, I see you're overweight when it comes to JD and Baba as well. Are these the companies that you think will maintain a certain level of resilience even if we get that broader slowdown and the new kind of slower normal growth situation in China?
So for Tencent, actually the bigger driver than gaming, in our opinion at Barclays, is its advertising business. This is the result of a very savvy strategic bet the company did about 10 to 15 years ago with WeChat, and a few years ago with video accounts. The Chinese economy is not doing great, and the advertising market overall is not doing great, but Tencent grew its advertising business about 26% in Q1 this year, and in the second quarter is likely to be up close to 20% as well. See, this is the result of some of the past smart decisions they made. So I think that's the biggest driver actually for the company's growth, outperforming the rest of the industry. Now, for the consumer or online e-commerce industry, is a little bit different story. Alibaba has somewhat struggled for years to protect its market share because they try to protect its profit margins. But now with the new management team, they pivoted towards growth. Now Alibaba is actually doing quite well in terms of protecting and stabilizing their market share loss to their peers. And I think in this current quarterly results, which we're going to hear from both Alibaba and JD on Thursday, Wednesday night, I guess Asia time, you're going to see Alibaba will do, in my view, perhaps better than JD has done in the second quarter.
Jiong Shao, who's the China Internet and Tech Analyst at Barclays. Really great to have you with us. We appreciate your time. Well, turning to Australia, and Commonwealth Bank CEO Matt Gomes says Australia's economy is well positioned after announcing a $6.5 billion full-year profit that met estimates. Bloomberg's Paul Allen is with us now. So profit is down more than 2% on year for CBA. The numbers in line. Are the headwinds sort of getting stronger?
It appears they could be. I mean, we are expecting rate cuts from the Reserve Bank of Australia sometime this year, so margins are getting tighter. And if we look at Commonwealth's net interest margin, it held up pretty well, 1.99%. That was better than expected, although less than we saw the previous year. The cash profit, 9.84 billion Aussie. That was in line, about $6.5 billion US dollars. And the final dividend, pretty healthy as well, $2.50 per share. And Commonwealth's been very active in returning profits to shareholders. It's got a lot of surplus capital, though. Its Tier 1 Tier 1 capital ratio is way above where it needs to be. There was some expectation that maybe there'd be an extension of the share buyback. There was no mention of that either. And some of the commentary from Matt Gomes does suggest, yes, maybe hard times ahead. He says Australia remains well positioned, but downside risks remain around productivity, housing affordability, and of course global uncertainty as well.
The share price was at a record high just a couple of weeks ago, still pretty close to that. A lot of analysts are defending financials, saying, there's a reason why they're expensive. There's still good opportunities there. Are investors going to feel the same way?
Yeah, well, I mentioned the buyback there, and it was kind of telling that in the last buyback, Commonwealth didn't take the opportunity to buy back any of its own shares. So the price to earnings ratio, it's up there. It's 23.3. Barrenjoey, one of the analysts we're talking about, says that is one of the highest multiples of any large cap developed bank that has ever traded. So the short interest ratio, that's something worth watching as well. It got above 20% again in July after touching that in February as well. With 0 buys on the stock, 3 holds, 13 sells. The interesting thing about Commonwealth, though, is retail investors absolutely love it. It's half owned by retail investors, and they just keep on piling back in. So plenty of predictions about where the share price might go from here. It's really, really high. Can it continue defying gravity? Well, we'll have our answer in about 20 minutes.
Yep, still a dividend and yield story for those retail investors. Paul Allen there in Sydney. More ahead on the Asia Trade. This is Bloomberg. Well, new research says water temperatures around Australia's Great Barrier Reef are the warmest they've been in 400 years. These findings reinforce fears that human-induced climate change is pushing the reef closer to a tipping point from which it may never recover. Bloomberg's Paul Allen has more.
Dire warnings about the risks faced by Australia's Great Barrier Reef are nothing new. But here's what is new, confronting data stretching back 400 years, recovered from the cores of coral samples.
They are actually living sensors that for us sit in the ocean for hundreds of years and recording what has happened to them over many centuries during their lifetime.
Like tree rings, they tell a story. In this case, a story about heat stress.
You see this kind of purple band, so that is a stress band, most likely formed during a thermal stress event.
The data from coral skeleton samples covers a time period from 1618 until 1995, and that's coupled with sea surface temperature data from 1990 to 2024. It shows stable temperatures before 1900 and then sharply increasing annual warming from 1960 onwards, firmly implying human-induced climate change. The coral bleaching events are not only becoming more frequent, the scale of the problem is also formidable.
The Great Barrier Reef is the size of Italy, so it's absolutely enormous. And you're talking here about a mass bleaching event can have the footprint around 10 times bigger than the most extreme tropical cyclone. So it's absolutely enormous area.
The good news is that corals can recover from bleaching events if sea temperatures cool. The bad news is the current trend line suggests there is no such cooling on the way. The message is familiar and unchanged: address the human behaviours aggravating the problem or risk losing one of the world's great natural living wonders. Paul Allen, Bloomberg, Sydney.
From the Great Barrier Reef, let's turn now to Australia's remote outback, where temperatures above 40 degrees Celsius are set to become increasingly frequent. That poses a challenge for a workforce of more than 60,000 in a mining region that's crucial to the nation's economy. Let's bring our metals and mining reporter Paul Allen Hunt for more. And Paul, the idea of these temperatures and working in the mines in the Pilbara in this sort of environment, it's almost like a literal hellscape.
You could describe it like that. I mean, it is a beautiful, picturesque part of the country. You know, banded iron, it's red earth. But you're right, it is extremely remote. It's some 300 kilometres inland. It is dry. It is extremely hot already, and it's just getting hotter. We're talking, like I said, 300 kilometres inland in a very hostile environment. It's almost treeless, so just finding shade is really hard. 60,000 people, as you said, work out there. They're mainly all fly-in, fly-out workers. Some come from as far as Hobart or even Melbourne for 2 weeks at a time. They spend in this place or longer before travelling back interstate. So that in itself, from Melbourne to the Pilbara region, is about 3,000 kilometres by plane. So just getting there and then working in that environment for 12 hours for your shift every day. These mines don't stop, so they're 24-hour operations, and they don't shut down either over Christmas, for instance. I was talking to one FIFO worker who described it as working in a fan-forced oven. He says you get sunburnt even when you wear a hat because the red earth just reflects heat back up at you. Even it's not necessarily getting sunburnt from the sun in the sky. And at the bottom of an open pit mine, I find this really interesting. Temperatures are actually even hotter than on the surface because the sunlight and the heat is just being bounced off the walls of the open cut mine.
That really sounds pretty insane. So if we continue to see this environment, we could even be seeing higher temperatures. What's at risk right now? Obviously, I'm thinking about workers' health, but what are companies thinking of right now?
Well, yes, workers' health is front and centre for every company. I mean, ESG is extremely important in 2024. And sadly, we did lose a worker some years ago, part of an exploration team up there due to heat stroke. But yes, there is a lot at stake elsewhere. You know, $90 billion worth of iron ore these heat waves get longer and we see more hot days over 40 degrees, it poses a lot of operational risks to that $90 billion worth of iron ore exports, in that even trains can derail. It has happened in the past when you have a heat wave of 40 degrees or more that lasts for multiple days. The tracks, the actual steel tracks, can start to buckle. So it is a huge concern. There's $90 billion worth of exports. That's our biggest export from Australia, at risk as climate change and heat waves become more common.
And yet we see mining companies continue to expand to, some of these very heat-prone areas, right? Reading through your story, I mean, we said 40 degrees. The record is 50 degrees from last December, in the middle of summer. So are they taking steps to try and be able to ensure workers can safely work in this sort of environment?
Yeah, well, I mean, the first thing you sort of think about is how does a worker even operate, a truck in that sort of heat? But it goes much further than that. I mean, there's some work that just can't be done in 40, 50 degree heat. So, you can't walk around in that sort of heat. Autonomous operations are really being rolled out. I mean, Rio Tinto doesn't have any train drivers anymore. It's all autonomous. So there's a huge push in making operations more safe. I mean, the safest mine site is one where there aren't any workers there. But more broadly speaking, BHP, for instance, has just launched or is at the tail end of finishing up a really big study into how climate change will impact its operations, but not just in heat, but all sorts of operations overseas too. So I think it's a problem that mining companies are just starting to really grapple with. I mean, we are talking decades into the future, so they are being proactive in trying to find some answers.
Metals and mining reporter Paul Lynn Hunt there, with, of course, a look at what's happening in some of these operating mines, but the push against climate change so much more important now, and we're seeing that transition to net zero production of steel, aluminum and petrochemicals as well, and that's facing an economic hurdle known as the green premium. BloombergNEF's latest report says some net zero products could remain more expensive for many years to come. Let's cross to Singapore now, and BNEF Sustainable Materials Research Head Tom Abraham. Alan, so talk to us about the economic viability of some of these net zero options in the decade.
Thank you. Some of these industries that we just discussed about, steel, aluminum, petrochemicals, these industries do not have a clear path to reach net zero. The technologies that some of the governments and companies are today considering are technologies like hydrogen, carbon capture, and the use of clean power and renewables in order to switch out fuel use to produce heat. But when we look at these options in a little bit more detail, what we are starting to see is that these options are sometimes and often more expensive than the conventional production methods that we use today using fossil fuels. For example, for the production of materials such as steel in markets like China or India, in our analysis, we see that the cost of producing green materials could be at least 25 to 35% more than the conventional production methods in this decade. And same is the case for petrochemicals from fossil fuel feedstock produced in a net zero manner. Again, premiums of about 30%. Some of these costs will go down because of technology improvements as well as economies of scale. But even in the long term, what we are starting to see is that this green premium might persist for long periods. And as a result, governments, companies, and even consumers would have to work together in order to make sure we move the needle enough to bring down emissions from these sectors.
What technologies are the most economic when it comes to decarbonising industries in Asia?
It actually varies a lot depending on the sector we consider as well as the market. Let me take the example of steel again, one of the largest emitters globally when it comes to an industrial facility. And what we are starting to see is in some markets like China and India, where these countries have easier access to cheaper hydrogen because of the easier access to clean power in the first place and also electrolysis, producing new green steel from hydrogen can be more economic compared to retrofitting the existing coal-based furnaces that these countries have, even by 2050. And that's a long time frame. And whereas in markets like Japan or Korea, where hydrogen can remain expensive because of the lack of renewable resources, retrofitting existing coal-based furnaces might turn out to be cheaper than using hydrogen. So the technology varies a lot by market and the sector. In the petrochemical sector, electrification and carbon capture are the two most promising solutions. But again, which company and which refinery deploys the solution will depend on the access that some of these refiners have to infrastructure such as carbon dioxide transportation pipelines and storage capacity. So in markets where you have easier access to CO2 transport and storage infrastructure, refiners may choose carbon capture. In other markets, electrification becomes the viable option.
And Alan Tom Abraham, good to have you with us, BNEF Sustainable Materials Research Head. And we do have more ahead on the Asia trade. This is Bloomberg. This is the Asia trade. Here are some of the latest from the corporate front. Bloomberg has learned BHP has resumed wage talks with union leaders in Chile in a bid to end the strike at the world's biggest copper mine. Sources say the main union at Escondida has agreed to BHP's request to revisit sticking points that prevented an earlier deal. Striking miners warn they have enough funding for a long period. Starbucks shares jumped after the firm ousted its CEO, Laxman Narasimhan, and hired Chipotle's Brian Niccol as its next leader. Niccol starts his new role next month. The shakeup comes after activist investors amassed stakes in the company. Narasimhan's abrupt exit adds to a record number of CEO departures from U.S. companies. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens as we await the U.S. CPI numbers on this Wednesday. Haidi, we already got some clues coming from the PPI data overnight showing the factory prices rose less than expected for the month of July.
Yeah, and arguably, Shery, these markets have already run ahead with expectations of a Fed easing, right? We did hear from Raphael Bostic from the Atlanta Fed really continuing to exercise some caution, saying that he wants to see sort of more evidence before backing the idea of a rate cut before the end of the year.
The expectations that we might get that soft landing in the U.S. have increased. There's a little bit more optimism about perhaps those rate cuts coming from the Fed and potentially a smooth landing when it comes to the markets, which is why we have seen really the Nikkei return to levels that we were at before last week's Black Monday. That helped, of course, the broader MSCI Asia Pacific Index also gain ground. The Nikkei now coming online up 0.8%, while the Topix is also gaining ground. The Japanese yen right now holding at that 146, 147 level for most of the week. We are now seeing retail investors thinking, though, that we might see more strength for the Japanese yen with net long positions against major currencies having been increased by more than 20% since the BOJ's rate hike just in July. And take a look, of course, at the 10-year yield right now holding below that 0.9% level towards that 0.8% level at this moment. Take a look at how the Kospi is coming online as well, because we had more indications of where the Bank of Korea might go from here, given those unemployment numbers that we got from the South Korean economy. The jobless rate unexpectedly sinking to 2.5%, which just means a very tight labor market in South Korea, potentially giving more ammunition for the BOK to delay its rate cut to later in the week. We're seeing the Kospi now gaining more than 1%, along with the Kosdaq and the Korean won a little bit stronger against the U.S. dollar. Haidi.
Shery, we're also watching Kiwi assets as well, and Kiwi-Aussie assets ahead of the RBNZ decision. Interesting, quite a split sort of view when it comes to what economists are expecting. Broadly, though, consensus is that we will see a hold from the RBNZ. Watching, of course, for that commentary, given that we have seen that, significant weakening when it comes to a lot of domestic activity indicators. Take a look at what we're watching as we get that staggered start to the open here in Australia. One stock that we are watching very closely is ASX. We're not seeing too much of a reaction, a little bit to the downside at the moment, about 0.5% trading for the ASX. Australia's securities regulator suing the ASX for what it calls misleading statements relating to this years-long process to upgrade the clearing and settlement system, the CHESS system, saying that the comments made in 2022 were not reflective of the progress, a true state of affairs, according to ASIC, given that the project was not progressing well, contrary to the statements made by the ASX. So watching that stock. The Aussie dollar is holding pretty steady, 66.37. When it comes to that sort of reaction we expect to see for the Kiwi, the dollar swaps are likely to move kind of regardless of what the RBNZ tends to do. Traders at this point aren't fully pricing in a cut from the Reserve Bank yet. So there is a little bit of room for swaps in the currency to move as a result of disappointment or not. So watching to see if the RBNZ further dials back that hawkish tone. Let's bring our next guest, though, who says we are still in the early innings of when it comes to what we see with the deployment of AI. With us now is Ed Gomes, who's a CIO at SGMC Capital. Ed, great to have you with us. So if you take a look at, I guess, a sort of a broad loss of confidence or loss of patience from investors in the AI, the tech, the sort of Mag 7 trade, do you think that presents more opportunities?
Well, I guess to a certain extent, the sell-off that you've seen in the last couple of weeks, for some stocks slightly longer, has been some amount of profit taking. It's been a great year for these investors, and at the first sign of trouble, some better investors probably exited even earlier. They've locked in fairly decent gains. So I wouldn't really say they're entirely giving up on the trade or the investment theme. Clearly, if you've made tremendous amounts of money, you do need to lock that in. At the same time, there are multiple flashpoints around the world geopolitically, which have to be taken on record and have to be. You have to adjust your portfolios for them. What's happening in Ukraine and Russia, what's happening in the Middle East, clearly not good news, just given the nervousness that brings. Added to that was the Bank of Japan. They're hiking rates now 25 basis points, going to 40 basis points. So not a very large nominal number, but a big shift for them. And, clearly if there's even a 20, someone who's been in financial markets for the last 25 years in Japan, focused on domestic investment, they haven't really seen interest rates like this. So, everyone's learning on the go, in Japan, and that's why you probably saw a very, very strong reaction over the last 2 weeks. You put all of these things together, clearly, yes, technology has been soft, but that's where the growth is. The multiple AI companies which will bounce back. You've seen NVIDIA up like 6% last night itself. This is despite the fact that some of their leading chips are going to be delayed maybe 3 to 6 months. But that's where the growth is. And we haven't even scratched the surface in terms of figuring out what all we can do as consumers of this technology, and it's only going to ramp up from here. So a long, long way to go.
You're saying that you're happy to buy the dip in assets as you see value. Does that mean you also see the blowout in volatility that we had over the past week as perhaps overdone?
Somewhat comforting that the Bank of Japan came out last week and said that they're going to keep an eye on asset markets and not unilaterally hike interest rates to the detriment of everything else. So that was a reassuring sign. We're still concerned about what's playing out in the Middle East. Everyone's gearing up for some kind of increased tensions, and does that lead to another round of escalation? Clearly that's something we just need to wait and watch for. Hopefully, you get some kind of peace accord, peace deal, ceasefire, sooner rather than later. But at this point of time, we need to factor that in. So we did reduce allocations the Friday before, the massive selling on Monday, just feeling a bit uneasy with where things were. And we do own call options to the upside, so we do tend to capture some of the gains. But we'd wait a bit before we pronounce like an all clear on the geopolitical front. You don't want to get into a weekend and see a weekend surprise and come in on a Monday morning and have to deal with that again. We're happy to be slightly lighter there.
And it was really interesting to see the market reaction with those CPI numbers in the U.S., for example, last month when we saw that great rotation towards cyclicals away from those big tech stocks. With the PPI numbers this time around overnight, we didn't see that. Of course, we'll still be expecting a reaction with CPI numbers. The expectation by investors, it seems, the recent surveys, that it will be a risk-on reaction. What will it look like here in Asia tomorrow after these U.S. CPI numbers?
Well, I guess we are trending to, lower inflation. Most of the forward-looking gauges, the surveys done of consumers are pointing to lower numbers. So that's clearly a good sign. When you're looking at, just looking at the Russell 2000, which you referenced, and the way that rallied, no one really knows, which of the 2,000 stocks in there. So clearly it's a great macro theme to play at certain points of time, but no one's really taking a directional call on many of those stocks, which happen to be in that index. And you compare that with the NASDAQ or the S&P 500, where people have much greater visibility into the names that are in those indexes, and you will see, some amount of recognition, name recognition there. To come to interest rates, you're already seeing 8 cuts priced in from now into the U.S. interest rate curve from now till the middle of next year. So, you're not going to see that much of a further bit of support coming through from an interest rate perspective. But just given the sheer nervousness that has been bandying around recently, that will provide some kind of relief.
What about for the Japanese yen? Retail investors expecting more strengthening from here. How cheap is the yen as a funding currency at this point?
Well, again, heading into the middle of next year, Japanese interest rates at about 40 basis points. That's clearly still in funding currency territory. Even if the U.S. rates drop to, say, 3.5, and I'm not even sure whether that's going to happen, because you could have a new administration coming in the U.S. with the elections, further programs being put in place, fiscal spending, which is just going to turbocharge the economy even more, which will mean that the Fed doesn't cut as much. So even if you have like a 3.5% rate of interest in the U.S. and like 40 or 50 basis points in Japan, that's still a fairly decent carry for investors to trade. So unless the Bank of Japan, plans on hiking rates to the point where it's getting to parity with its, international counterparts, you're probably going to see a bit of a drag on the Japanese yen. Clearly cheap if you look at all the other models, but that's not what the Bank of Japan is looking at. They need a weak currency for their exports. The domestic market is not growing. Demographics are not that great. And as a function of that, we don't trade the Japanese yen because it tends to be like massively volatile in short periods of time. But we keep a very, very close eye on it, just given the importance of the currency as a funding currency.
Ed, always great to have you with us. Ed Gomes, CIO at SGMC Capital. Take a look at how we're trading when it comes to Kiwi assets. In the overnight session, we saw a pretty strong gain when it comes to the Kiwi dollar, almost 1%, close to that 1-month high as we head into RBNZ decision day. The views are pretty split. In fact, economists, we're looking at about a 60-40 split. Most are expecting a pause. The rest are calling for a 25 basis point easing, which would bring that rate down to 5.25%. So traders have turned significantly more dovish from about the first week of July. We had CPI slowing, the RBNZ sort of dialing back its hawkish tone. So it makes for a very interesting meeting. And that call comes in just a few hours' time. Let's bring our economics reporter, Haidi, who joins us now. So why is there sort of so much debate about this meeting? And we know that Governor Orr isn't one to sort of unnecessarily shock and awe.
Yes, that's right. This is a crunch policy meeting. There's a lot of excitement around it, and it looks like there will be a lot of volatility in rates and currency market in the lead up, but also during the decision. One of the biggest reasons is their last policy meeting in July was dovish, more dovish than markets had expected, and that had come after a hawkish meeting where they had raised their forecast, where they had extended the timeline for when interest rate cuts would happen, and they had discussed a rate hike. And then July was dovish, and then data since July has been pretty weak as well. So that is leading markets and economists to believe that the time is ripe now for the RBNZ to begin cutting interest rates. Otherwise, they will probably have to do like larger 50 or 75 basis point moves.
You mentioned the weakness in the data. How's the broader economy sort of tracking? And particularly, some of the sort of demographic immigration numbers are quite interesting.
Yes, immigration is the weakest in. So the people leaving from New Zealand, that's the highest in 16 months. A lot of New Zealanders are leaving for better job and better pay. Many of them are coming to Australia. We've written about that as well. And I was in New Zealand. Yes. I was in New Zealand in July and talking to small businesses and people and economists there. It just felt like the feeling of recession is a lot more there. And even data is suggesting that New Zealand will enter likely its third recession in 2 years. So their economy is pretty weak. Unemployment rose in the latest report. So that's 4.6%. In Australia, we are at 4.1%. So by comparison, New Zealand is definitely feeling a lot, but also their interest rates are a lot higher too. They went up to 5.5%. Inflation has come down. It's come down to 3.3%. The RBNZ's target is 1 to 3%. So it's pretty close to that target as well. So I mean, looking at all of that, economists and markets are saying that it's now time for RBNZ to move.
Yeah, Bloomberg Economics, though, does expect a likely pivot, right? So if they were actually to hold and decide against a cut, what would be the language to look out for in the statement?
If they decide to hold, the expectation is that they will continue their dovish line that they did in July. I think this is also this is the monetary policy statement where we get fresh forecasts. So that is something that everybody will be keenly watching out for, where their forecast for economic growth is, where their forecast for inflation is. And also they provide some sort of like dot plots for where they see the official cash rate. So all of that will really be critical to suggest where they are thinking, like when they start cutting rates and how fast they will go.
Economics reporter Sari Pandey there with the latest, and of course we're counting down to the RBNZ and really looking out for the tone of remarks that we get from Governor Orr and the broader committee there. Take a look at some of the moves as we're watching. We had a look at ASX a little bit earlier, just seeing sort of a little bit of modest downside that can be characterised as we continue to see kind of the reaction to the lawsuit from the from ASIC, I should say. The ASIC saying that it's carefully reviewing and considering these allegations by the Regulatory Commission, the Securities Commission, about misleading statements with regard to the progress being made in the upgrade to their clearing and settlement system. We're also watching Commonwealth Bank. Of course, this is a heavyweight, upside of about 0.8%, more or less in line. We saw profit expectations meeting the sort of estimates, but margins dipping, and potentially the risk of global uncertainty as well as the sort of macro slowdown domestically, the impact of potentially easing from the RBA as well being highlighted by CEO Matt Common there. Home loan customers, though, remain ahead on scheduled payments, so it's interesting. We haven't seen that sort of mortgage cliff, if you will, that had been very much well flagged going into this hiking cycle. We're also watching BHP down by about 0.6%. They've resumed those wage talks with the union leaders at the Chilean copper mine. More ahead on the Asia trade. This is Bloomberg.
Take a look at how some of these Asian tech names are trading at the moment. Big moves for SK Hynix, up more than 3%. Samsung also leading the gains there, and we're seeing gains for 4 consecutive sessions for the Korean giant. We're talking about the best day in about a week. This, of course, as we're really watching that tech rally in the overnight session, with the Nasdaq 100 gaining more than 2.5%. And this, of course, coming at a time when we saw the PPI numbers rising less than expected. When we saw some of those decelerating inflation numbers last month, we saw that great rotation out of tech. But this time around, we're seeing still big tech outperforming small caps. We're also watching these tech giants across Asia because we have Chinese tech name Tencent due to release earnings later Wednesday. It's one of the most closely watched reports across this week in Asia. Bloomberg's Annabelle Drewlers joins us to preview the second quarter figures. Annabelle, what are we expecting from Tencent today?
Yeah, pretty strong quarter actually should be in the cards for later. What we're expecting is a healthy rise in net incomes, up around the 50% mark. And then as well, revenue should have jumped around 8%. It has been quite a good period for Tencent for a number of different factors, but most important for a lot of analysts who are saying this is really the key company to track this week is just the fact that Tencent is a lot more insulated when you compare it to its peers in the China tech space. That's because, for instance, it's got its gaming division that's a little bit better insulated from the economic issues that are facing Chinese consumers. And then also it's a lot more diversified. There are higher barriers to entry. It's not seeing that same sort of competition that you've got for the likes of Alibaba, JD.com. They're reporting tomorrow, and they're really facing a lot of different competition pressures from the likes of Shein, Temu, for instance. So Tencent, really, as we said, better numbers could come through, and that also lays the ground perhaps for an enhanced share buyback program.
There's a lot more excitement when it comes to the gaming division. Maybe not necessarily for this set of numbers, but certainly going forward.
Yeah, absolutely. It's been really a remarkable turn of fortunes for China's gaming sector overall. We had such a long period where Chinese regulators weren't approving new titles. That's been really flipped on its head, and we've seen a number of new ones actually being given that green light to move forward. In this reporting period that's going to be released later today, we had the title Dungeon and Fighter Mobile, DNF Mobile, being released. That has performed exceptionally well on the charts. It's been the most downloaded. There's been the most receipts as well, or gaming revenue coming from that. Because of that, it could really lay the groundwork again for further success in the third quarter as we move ahead. The scenario, of course, perhaps stays intact for 2024, 2025. Yes, Bloomberg Intelligence team is saying that probably you'll see that earnings growth around 25-30% this year should move down to that 10 to 12% range, Heidi.
Annabelle Drewlers there, our tech reporter, with a look at some of the key tech earnings that we'll be following today. Take a look at how Google is trading after hours at the moment, as we have our report that the Department of Justice in the US is really considering the breakup of Google after the landmark antitrust win. Antitrust enforcers are soliciting input from outside companies. That judge, they're ruling the Alphabet unit had monopolized online search and ad businesses. This is according to people with knowledge of the deliberations. Still quite a bit of downside when it comes to trading in Alphabet shares there. Let's bring in Bloomberg Seattle Bureau Chief Anna Edgerton, who joins us more with this. So what do we know? What's sort of under consideration here in terms of the possibility of the remedy?
Yeah, so kind of where we are at in the process is that we've already had that liability ruling from the judge that you mentioned, and the next phase of this is going to the remedy trial. And so for that, the Justice Department is going to present a proposal to the judge about how they think this liability, this harm that was found on Google's part, should be addressed. Now, we've reported that part of that should include a breakup of some Google units, looking specifically at the Android operating system, which is on 2.5 billion devices worldwide, as well as the Chrome web browser, and also AdWords. This is the platform that Google uses to sell text ads. So these are really the units of Google's business that could be broken off in order to address the underlying harm that the judge found in this case.
Other than a breakup, what else could be in the remedy that the DOJ is seeking?
Yeah, one element that the judge highlighted specifically in his ruling was that Google signs these agreements with mobile device makers to make their browser, their Chrome web browser, the default on a lot of these devices. And so that's one of the agreements that we think that the Justice Department could seek to address, asking the judge to prohibit that kind of agreements. And this would be specifically for Google, having been found to be a monopolist, would be prohibited from signing these kind of agreements.
All right, Anna Edgerton, Bloomberg Seattle Bureau Chief with our Bloomberg Scoop there on Google. We have more ahead on the Asia trade. This is Bloomberg.
Growth is slowing, okay? Earnings expectations probably are still too high for the second half of this year. And a Fed that's reluctant to be proactive, okay? And I don't disagree. People are criticizing the Fed. I'm like, well, look, they're just being data dependent. I mean, and so they're doing their job. They're going to react if they need to. If they overreact, then that probably exacerbates the carry trade problem.
Morgan Stanley Chief U.S. Equity Strategist Michael Wilson on the Fed's policy path, of course, as investors and traders really try to gauge where the U.S. economy is going from here, especially if we're headed towards a hard landing. And Haidi, we're seeing more calls, especially from Goldman, from JPMorgan, that markets are pricing in higher recession odds. When it comes to Goldman Sachs, now they're seeing that together equity and bond markets are assigning a 41% probability to a U.S. recession. That's up from 29% in April. JPMorgan, with a similar calculation, sees the odds to be 31%. That's also higher than the 20% since the end of March. This is, of course, given the sharp repricing in U.S. Treasuries.
It's interesting, rates markets are actually pricing in the higher odds of recession that equities, the Goldman and JP Morgans are necessarily doing at the moment. Pointing out we're still, down about 4% since the record high in about mid-July when it comes to US equities. But interestingly, speaking of JP Morgan, we have seen Marko Kolanovic resurfacing on X, on social media, after his departure, his pretty high-profile departure. There's been lots of speculation as well, when he's going to rematerialize, and we're seeing him now on social media. So it's very, very interesting. If you want to follow him, he's at Marko in NY, I should say, really posting on LinkedIn and X for the first time since reports in early July that he was leaving his role at the bank. And of course, he was sort of one of the last vocal critics or skeptics left on Wall Street, right? But a number of his views had failed to recently materialize. We are about 30 minutes into trading here in Asia. These are the top stories that you should know. Alphabet shares slipping after the bell after sources telling Bloomberg that the US Justice Department is considering a rare bid to break up Google. A landmark court ruling earlier this month found that the company monopolized the online search market. Bloomberg Intelligence expecting Tencent to report strong second quarter results later, partly driven by momentum in its domestic video games business. Its new release, Dungeon and Fighter Mobile, has topped download and spending charts in China. Shery.
Take a look at how broader markets are trading across Asia. It's a risk-on day, Haidi, as we're seeing the Nikkei gaining 0.3%. We're already at levels before last week's Black Monday. The ASX 200 also gaining 0.5%, and the Kospi gaining ground for a fourth consecutive session, especially after the jobless rate unexpectedly fell to the lowest level since October, of course, perhaps giving more indications that the BOK might wait a little bit before cutting rates. Let's discuss the broader markets, especially when it comes to trading in these markets. With Securities, an online trading app that offers Korean and U.S. stock trading. The company says it's attracted more than 6 million customers since its launch 3 years ago, with around 3.2 million active monthly users. Let's discuss the investment environment in Korea and the company's outlook, of course, with CEO Seungyeon Kim joining us now from Seoul. Seungyeon, it's great to have you with us. So tell us a little bit about your app and what differentiates your trading app from others.
Hello. So we started our company 3 years ago. This is our fourth year in operation. We grown from about 2% market share in U.S. equity to about 22% this year. And we were the last sort of a licensed brokerage platform in Korea to give in the license. And today we are the only one operating in the mobile space.
When it comes to operating in the mobile space and just broadly speaking of trading apps, we have seen a lot of market volatility and perhaps some issues for these apps. How do you really overcome the uncertainty of really incredibly volatile markets, especially given what happened last week, for example?
So I think as a company, we are not able to predict the market and its fluctuations. But what we can do is we have been heavily investing in our infrastructure and security over time, and I think it really helped us going through these volatile market situations.
What is your focus next in terms of where you want to take the business next?
So. What we are doing is we've grown our U.S. equity trading. We are not only a mobile trading fintech platform, but we have a social extension community for U.S. equity and also markets, which is like Reddit in U.S. And what we are trying to do is as we are growing our U.S. equity business, we will be sort of launching our operations in U.S. and enter U.S. market.
We've seen a lot of efforts being made in terms of, improving the value of Korean equities and attracting foreign investor interest. Have you seen that being reflected in your user flows?
Yes, I think it's very interesting, currently very interesting because the U.S. equity market in Korea has been increasing last 4 to 5 years, and it's growing faster than domestic market. And I think that users are learning to, portfolio manage and diversify their investment across Korean equity and the U.S. equity in our platform.
Yeah, I was going to say, how much appetite is there among Korean users to really learn about the markets, not only in South Korea, but globally, and just get their money in there with these trading apps?
So I think there's a huge volume of sort of information that we feed to our users. For example, in our social extension, any given day there are about 12,000 sort of writings or posts regarding U.S. equity. And what we are trying to do is we want to make sure that we deliver the message real time. I think that is one. Two, we are using sort of AI to making sure that we also give them sort of a sentiment analysis on the news and then relevance on their sort of portfolio.
Do you have any guardrails about these retail investors that could perhaps be over-leveraged, that could not understand what they're doing very much in these trading apps?
So we don't really have the guardrail, but we are working closely with the regulators to making sure that we follow, country level, guidance on what to do and what not to do. But at the same time, we want to make sure that it's our job for, as a retail, investor-focused platform to make sure that we give them, necessary information and the correct information to make their financial choices.
You've talked a little bit about your US expansion. Can you give us a little bit more details on that? What sort of deliverables you might be looking for? And also, are you looking at any other markets or global partnerships at the moment?
So we are currently already working with key 5 to 6 partners in US because we deliver US equity trading to our users. But at the same time, it makes a lot of sense for us to expand into US market and work more closely with them. I think second, we want to go beyond just retail trading in Korea. We are looking into B2B space and US market. At the same time, we don't have any plans to enter other markets. As of today, we want to make sure that we focus on U.S. market and make sure that we deliver in the market first before any other expansions in other markets.
How do you see competition when it comes to the U.S. market or the South Korean market as well?
So I think it's a very interesting time for Korean market today because fintech, mobile app-based players like us, we are sort of innovating the space with retail investors. But at the same time, existing players that have been around 30 to 40 years, they're also playing the mobile game. So it's a very interesting time for us in the Korean market, especially in U.S. equity trading. I think it's helping us to really innovate and making sure that we deliver more, better products to the market. I think that's happening in Korea. Two, we don't have any plans to launch a B2C sort of a product in US, but we are looking into B2B space, working closely with the partners. That is something that we are keen on doing in the US market.
Seungyeon Kim, who's the CEO of TOS Securities. Really great to have you with us. More ahead on the Asia trade. This is Bloomberg.
Here are some of the corporate stories that we're following. Australia's securities regulator is suing the ASX for allegedly misleading statements relating to upgrades of its clearing and settlement system. ASIC says the exchange's claim in February that changes under its so-called CHESS project were progressing well were not true. ASX CEO Helen Lofthouse says the company recognizes the serious nature of these proceedings and cooperated fully with ASIC's investigation. U.S. advisory firm Alvarez & Marsal plans to boost its Australian headcount by more than half on expectations more firms will run into financial difficulties. The company sees rising interest rates adding to stress at firms. A&M is looking to employ 500 people by the middle of next year across businesses, including financial due diligence, performance improvement, and tax. Bloomberg has learned BHP has resumed wage talks with union leaders in Chile in a bid to end a strike at the world's biggest copper mine. Sources say the main union at Escondida has agreed to BHP's request to revisit sticking points that prevented an earlier deal. Striking miners warn they have enough funding for a long period. Starbucks shares jumped after the firm ousted its CEO, Laxman Narasimhan, and hired Chipotle's Brian Niccol as its next leader. Niccol starts his new role next month. The shakeup comes after activist investors amassed stakes in the company. Narasimhan's abrupt exit adds to a record number of CEO departures from U.S. companies. Haidi.
Shery, the shake-up at Starbucks comes as the chain looks to make inroads into India, traditionally a nation of tea drinkers. Tata Starbucks CEO Sushant Dash told us about their strategy to boost growth in the market by adapting to local demands.
It's about category creation. You know, today we are a tea drinking nation. Tea penetration is 91%, 93%. Coffee penetration is 14, 15%. Even amongst the affluent class, right, maybe the kind that we are targeting, coffee penetration is 25%. It is 18 million people. I want to grow that because if I have to grow and I have to open 1,000 stores, the big thing is that I need to increase the category, right? That is what I am. So it is about category creation. To make category creation, you need to ensure that people are comfortable coming into a Starbucks. Today, people come to a Starbucks because of an occasion, because they are meeting friends, because there is an office meeting. You need to convert it into a habit. That's what will give us, that is what will help us to grow Starbucks, the brand, and us as a business.
Average revenue has to increase per customer?
In India, it is about volumes. And that is where I was coming to, which is why, if you look at it, we realized, for example, in a group, today, if you're going out from office, let's say there are 6, 7 of you, 4 of them say, okay, let's go to a Starbucks. 2 people might say, hey, I don't drink coffee. You know, let's go to a place which serves both tea and coffee, right? So we launched, so today we have masala chai, we have elaichi chai, we have filter coffee. Similarly, we heard, let's say, we realized that, let's say, couples, right? Or the husband, wife, they will come during the weekday. But during weekends, we realized that they don't come to our store. And when we went and asked them, why you don't come to our store, we realized people saying, you know, we have kids. So we want to go to places, and as Indians, we don't serve tea and coffee to kids, right? It's an adult drink. So we launched milkshakes, which maybe doesn't exist in other markets. And we have now seen that, yeah, so their families can then come in to a Starbucks. So those are things that you need to do for India specific. And more so as you go into markets where the category penetration is lower. Because you need people to come to the store and then they will discover. Then our partners will take over. It's about the experience. It's about the ambience. And I think that's where food plays a big role, right? In India, again, unlike the West, even at home, when you have your cup of tea, you will always have a biscuit or you will have a snacks, right? We never give a beverage by itself. We always give people a snack along with it. So food attachment for us, to answer your other question, is high.
What would be the mix right now between food and...
I'll share that with you.
And how much is food increased?
So food is around 20% of a mix. Beverages is around 80%. It's not around 80%, it will be around 70-75%. The rest would be, your at-home coffee, merchandise and stuff like that.
And that's higher than the global average?
I think so, in terms of the food. And one of the things that we realized in India when it comes to food is there is a preference for local taste flavors. But obviously, you don't come to a Starbucks to have vada pav or to have your samosa. And we will also not match up to the guy who is doing it. He will do a better job. That's not my core competency. So the idea is to give flavors, local flavors, but do it in a format which is Starbucks. So each market, now we have gone to the extent of localizing, and I think that's the other part of the story, India growth story. You cannot treat India as one.
Tata Starbucks CEO Stroud-Watts is speaking with Bloomberg's Advait Palapu. Well, Japanese health and beauty products are starting to lose their luster in the Chinese consumer market. Our China correspondent Min Lo joins us now from Hong Kong. And online sales of Japanese-made supplements and cosmetics are slumping. Why?
Yeah, well, Chinese consumers have for a long time had a love affair with Japanese products because it's often a symbol of quality at a time when China had in the past struggled with safety scandals when it comes to products like milk powder and cooking oil, for instance. But now you see the competitive landscape really changing with the rise of Chinese domestic brands that are producing products that are cheaper and increasingly better quality. You also have a weak domestic demand now that is kind of spilling over into demand for foreign products as well. And then at the same time, you have these diplomatic standoffs with Japan. Remember that nuclear wastewater treatment, the dumping of the nuclear wastewater that was treated by Japan into the ocean, that had angered Beijing. It had led to a form of consumer boycott. And you also have safety scandals recently as well. Some Japanese pharmaceutical supplements made from red yeast that were suspected of causing dozens of deaths. And so that's why you see this retreat of Chinese consumers when it comes to purchasing Japanese products. You see pharmaceutical products, for instance, that are being sold on online platforms like Tmall and Taobao declining in sales by more than half in the first half of this year. And when it comes to cosmetics as well, Shiseido, SK2 are looking at sales down by 40% in the second half of last year compared to 2022. And that's led to some Japanese companies pulling back investment from China. Isetan, for instance, had closed down their store in Shanghai, leaving just one store in the entire country. Uniqlo as well, decelerating expansion in China, and they're focusing now more on revamping their existing flagship stores.
Yeah, and you can really see that pullback when it comes to demand and consumption in China, right? The latest credit data showing new loans for the real economy contracting for the first time in, 19 years?
Yes, it's a very grim milestone for China because this is a classic case of balance sheet recession. It means that households and businesses are paying back more loans, more debt than they are taking out, especially when it comes to households. The new loans is negative 220 over billion yuan. That means they're cutting down on short-term loans, they're cutting down on mortgages amid that housing crisis, and they're repaying more of their debt. When it comes to companies in the non-financial sectors, they're borrowing 150 billion yuan in July. That is the weakest print we've seen since October of 2019. So there's increasingly this fear that China could be following in the footsteps of Japan's economy, where you have years of stagflation that was the root cause of households and businesses refraining from spending. Now, in China's case, debt levels in households and businesses are still stable at this point, so no sign of rapid contraction yet. But when you look at real interest rate, it's still quite elevated given the very low inflation numbers that we are seeing. And so that's why many economists are calling on the government to spend more, to borrow more, to help stimulate the economy further.
Overall, aggregate financing also came in much weaker than expected as well.
That's right. Aggregate financing came in at over 700 billion yuan. The expectation was 1 trillion yuan, so missing estimates by quite a bit. A part of that is a seasonal demand because in July is not a time when banks would rush to give out loans because they're not in a rush to hit their quarterly loan target. But at the same time, bear in mind, a big part of that aggregate financing is bolstered by government financing, which accelerated for 3 consecutive months now. And we expect government financing to continue to help push up aggregate demand in the coming months, because even if the PBOC cuts rate in the last quarter, that's not likely to be enough to boost demand, given that the property sector is still in the doldrums.
Bloomberg China correspondent Min Lo there with the latest on the Chinese economy, as we're also awaiting Chinese tech giants reporting this week that will show us sort of where the Chinese economy is right now. But take a look at how stocks in Hong Kong have been trading. Of course, the market opens in less than half an hour, and the Hang Seng Index closed above its 200-day moving average for the first time in 2 weeks on Tuesday. This is really sort of clearing a major hurdle for a potential further rally. The MACD line, which indicates momentum shifts, also turning higher, and this momentum pickup ahead of those earnings, that could be a positive sign. So we'll be watching the reaction after Tencent later reports on Wednesday. We have more ahead on the Asia trade. This is Bloomberg.
A Thai court is set to decide if Prime Minister Srettha Thavisin violated ethical standards and should remain in the nation's top job. Let's bring our Bangkok reporter Patricia Tanaka-Sempipat. And Patricia, what is these allegations about, and what are the potential outcomes we're watching?
Yes, Heidi, the issue at hand is whether Srettha violated ethical standards under the Constitution when he made a controversial cabinet appointment back in April. A group of senators who launched this complaint against him argued that the minister was not qualified for the job because he was jailed in 2008. And they also argued that the Prime Minister should be disqualified for making such an appointment to the cabinet. Now, there are only two ways this afternoon could go. The court will find Srettha either guilty or not guilty. Apparently, the not guilty verdict will be the more straightforward scenario of the two, as that would mean business as usual for the government and pose no immediate risk to the ruling coalition.
And yet a guilty verdict could also be on the way. What does that mean for his cabinet and for the Prime Minister himself?
Yes, Shery, the guilty verdict would mean that Srettha would be immediately removed from office and he would be taking the entire cabinet out the door with him. Now, that will set off a scramble among the coalition parties to negotiate and agree on who their next prime minister candidate would be for the House of Representatives to vote on. There are currently 6 eligible prime ministerial candidates among the coalition parties, including 2 from the ruling Pheu Thai party. The successful candidate will need more than half of the support from the elected lower house before he or she can go on to form the new cabinet. Now, the whole process may take weeks, and during this time, Thailand may be exposed to policy paralysis in the meantime.
You've mentioned the policy paralysis. Are there real implications for investors, for the broader economy?
Yeah, the verdict will be watched by foreign investors who will be looking for political stability in Thailand, especially so soon after the political deadlock that followed the 2023 general election. So far this year, foreign funds have pulled more than $3 billion out of local markets, and the benchmark SET index fell to a 4-year low last week. If Srettha is out, then the immediate concern will be on the fate of the budget bill for fiscal year 2025, which starts in October. And if Pheu Thai is not able to retain the premiership, then the $14 billion digital wallet cash handout scheme that is supposed to stimulate the economy might also be delayed or canceled altogether, which will pose risks to economic growth.
Bangkok reporter Patricia Tanaka-Sempipat there. And take a look at some of the big movers in today's session. We're looking at ASICS here in Japan. It's falling after posting second quarter results. They beat the average analyst estimate, but at the same time, they capped their share buybacks at 20 billion yen. And yet we're seeing a rally when it comes to Sapporo, more than 10% gains for the stock. It said that it will solicit proposals for investment in its real estate business from external entities. We're also following e-commerce company Mercari right now under pressure after sales forecast missed estimates. Their net sales for the full year forecast missed, a guidance also missed, Haidi.
Yeah, take a look at the movers we're watching in the Australian session. And CBA is a major one when it comes to the index heavyweight, but also heralding perhaps some expectations for the other major financials that we're seeing. Very, very high valuations. But CBA, these numbers more or less in line with expectations, but still some forecasting of potentially more difficult macroeconomic conditions to come. We are seeing a bit of upside there to the tune of about 0.5%. Also watching BHP there as we see sort of a little bit more progress being made when it comes to the resumption of wage talks with union leaders at the Chilean copper mine, I should say, in a bid to try and end this strike that began earlier on Tuesday. This is the world's biggest copper mine, so we'll be watching for those developments in particular. And of course, ASX is in focus given the lawsuit from ASIC. ASX saying that it's carefully reviewing these allegations over these misleading statements over its settlement system. This is Bloomberg.